welcome to Market Domination. I'm Julie Hyman, that's Josh Lipton, live from our New York City headquarters. We got 1 hour to go into the market close. It has been another absolutely wild day on Wall Street. It's been mostly lower lately, but today it is higher following comments from President Trump that he will unilaterally be raising the tariff rate on China to 125% and instituting a 90-day pause on those so-called reciprocal tariffs on non-retaliating countries. And so the drama that we have seen today in the markets has been, we haven't seen anything like this in a long time, to the upside at least. We've been seeing a lot of action to the downside. The Dow rising 21 points and just rocket ship straight upward, up more than 6%. The S&P 500 up almost 7%, and the NASDAQ Composite rising almost 9% at one point today, really seeing its biggest one-day gain that we have seen in years, going back at least till 2020.
Yeah, I mean, Trump did say, Julie, be cool. I mean, he said be cool. He was on social media. Be cool. Great time to buy. I think it was all caps. I think there were some exclamation points in there.
He says a lot of stuff the time,
but was
Josh.
he tipping his hand? Maybe, I don't know, because now you have the averages. They're soaring today. I think in part what investors are really focused on here is the time frame you mentioned, which is this 90 days, and they're thinking, you know what, it's 90 days where folks can talk, they can negotiate, right? What's gonna come out of that exactly? Out of that 90 days, you have no idea, because frankly, it gets very complicated very quickly, because you have to have dozens of negotiations and dozens of deals. But I think investors are just focused on, you know what, at least right now, if the guns go silent for 90 days, they're setting stocks higher.
But that's a big bet to make, to be clear. Given what we have seen from this administration, that is a big bet. Also consider there's still 10% tariffs on everything. There's still, I believe, 25% tariffs on Canada and Mexico. It doesn't seem like those have gone away. And there are still sector tariffs on autos and on aluminum and steel. So we haven't gone back to zero, right? We haven't gone back to baseline. We've just gone back a little bit to where we were before. And there was a lot of talk about the Trump put, right? How will stocks go far enough at some point that he will blink? And there was a lot of pushback from the administration and its representatives against that idea. But was the put not in the stock market at all? Was it actually in the bond market doing the opposite thing that the administration wanted it to do? We did see initially, of course, yields pulling back in pretty decided fashion, but then they started going back up again. Was it that finally changed the mind?
Treasury Secretary Besson, talking to reporters, is saying, and you heard him, he was saying, listen, why did this happen? It happened because more than 75 countries picked up the phone, because more than 75 countries are calling us and they want to talk, they want to negotiate. But to your point, it does happen when the stock market is getting whacked and you have a big sell-off on treasuries where yields are doing the opposite of what Besson wants.
Well, and he can say whatever he wants. Is this an administration that has any credibility with what they say? The president said early in the week, I'm not going to change my policies. Peter Navarro says we're not going to negotiate. Then you have other members of the administration that say we are going to negotiate. So,
well, that's a very interesting question too, which is, it was helpful to get to our very smart reporter, which is, do you see today, if you're an investor, do you see, okay, does that tell me or suggest in any way who could be in pole position in that administration? Besson, Lutnick, Navarro.
All right, let's take a look at a couple more things here before we get to the nitty-gritty of the announcement that came today. And we got to look at what's going on in tech in particular, which was already rising earlier today, but now you see some pretty spectacular action. By the way, you notice here, Microsoft still bigger than Apple in terms of what we're seeing in market cap. NVIDIA, though, soaring by 15% following this announcement, even though the tariff's still in effect on China, but not on Taiwan, which is where the chips get manufactured here. The little bit of red on your screen here is PDD, which is, of course, a Chinese company that trades here in the U.S., but elsewhere you see a sea of green. Tesla, 19% higher here. So obviously, just seeing enormous magnitude of gains across the board. Here you see the sectors, XLK, which is tech, up the most, consumer discretionary. A lot of these apparel and footwear makers rallying, especially those that are more leveraged to Vietnam than China, really seeing a lift today. Industrials, materials, you name it.
By the way, airlines ripping higher today. We have an analyst to talk about that too. Treasury Secretary Scott Besson, as we were just talking about there, speaking out a short time ago from the White House, praising the president's negotiating strategy.
It took great courage for him to stay the course until this moment. And what we have ended up with here, as I told everyone a week ago, they're in this very spot, do not retaliate and you will be rewarded. So every country in the world who wants to come and negotiate, we are willing to hear you. We're going to go down to a 10% baseline tariff for them, and China will be raised to 125 due to their insistence on escalation.
Let's bring in now Yahoo Finance's very own Ben Worschel. What a difference a day makes, Ben. My first question is, Ben, I was just talking to Julie about this. Why now, Ben? Why do you think Trump made this reversal at this moment?
Well, according to Bessent there, one thing he said at a different point is that this was Trump's plan all along. The way he described it as this was a conversation he had with Trump in Florida on Friday. Bessent was definitely down in Florida with him in Mar-a-Lago, and that this was sort of part of the idea here that he was going to wait for this day to do it. You know, there's a lot of questions around that you guys raised at the top about sort of the bond market and the stock market having so many problems in recent days, sort of forcing this issue. But their case here is that this is sort of part of the quote art of the deal, and that they're trying to do this. A couple other points I'll make too on sort of what we saw this afternoon, and I think in the market reaction. One is I do think Bessent being the one that came out to announce this is a signal to markets about kind of which side of Trump's aides are in charge here. Terry Haynes at Pangea Policy made this exact point in an initial reaction, that Bessent being the kind of pole position person here, the person that talks about this, is a signal to markets that other folks that have been more hardline, the Howard Lutnick, Peter Navarro's of the world, aren't as positive. So that's one aspect that I think is important here in this announcement in terms of the optics. The other one is, the big one, is that this is kind of increasingly becoming all about China. Bessent at another point said that China is the main problem with U.S. trading at this point. And so it's a clear focus on China. And what also is happening here in Washington this week is that negotiations are happening, not just with any countries, but with China's neighbors, with Vietnam, South Korea, Japan, to create deals there first to kind of increase the pressure on China.
And yet, Ben, I'm seeing, for example, the New York Times is reporting not only are the 25% tariffs on Canada and Mexico, our closest trading partners, still in effect, but it sounds like they're getting the additional 10% that's the universal tariff on everybody else.
Yeah, that's one of the questions there. Bessent answered yes in response to that question about this afternoon. So it's unclear how that works. They're already paying more than 10% based on these illegal immigration and fentanyl duties that were in place from even before Trump's Liberation Day announcement. Another big question here is the European Union. They announced their own reciprocal tariffs, and Trump's whole reason for raising the rate on China was because of their reciprocal duties. And the White House isn't answering questions yet about whether European Union will go down to 10%, or it'll raise, or what'll happen there.
Thank you, Ben, for trying to make sense of this very fast-moving situation. Thank you so much. Let's talk more about today's roller coaster market action now. Joining us now, Chris Morangi, Gabelli Funds co-CIO of Value, which had been gaining some steam, right, this year, Chris, although today seems to have upended things yet again. What do you think of today's news and the market reaction, and kind of what happens now in terms of the strategy that people had been trying to set that, as I said, now sort of gets upended again?
Well, this is the kind of stuff that gets us up in the morning, keeps us employed as active managers. We should have come to expect the unexpected through, 79, 80 days of this administration. I'm a little surprised that he walked it back as quickly as he has. Still a lot of questions out there, as you noted, including, what happens with China, what happens with Canada, Mexico in particular. But the question becomes, where do we go from here? And we don't just simply roll the clock back 1 week. The odds of a recession are probably lower this afternoon than they were this morning, but they're certainly higher than they were a week ago. Enormous wealth destruction, a blow to consumer confidence, corporate confidence. And so earnings are probably lower. And then you got to think about the multiple, a little harder to ascertain. But, certainly investor confidence and the predictability of policy in the U.S. has gone down, maybe not permanently, but certainly for the short term. So we're not going back to where we were a week or even 3 months ago.
Chris, I'll ask you to speculate on this next one, which is why this happened now, Chris, and why this happened at this moment. We were just talking to our colleague there, Ben Worschel, about this. I mean, listen, the administration's view is, listen, this is the art of the deal. More than 75 countries picked up the phone. They're talking to us. They're negotiating with us. Others might look at this, Chris, and they think, it looks to them like maybe Trump blinked. The stock market was getting hit. There was a sell-off in treasuries. The yields are moving in just the opposite way what Bessent wanted to see. Or who knows, Chris? Maybe it was a mix of the two. But what do you think?
Yeah, I kind of fall into the latter camp. One of the questions certainly we've been talking about for weeks and weeks is there a Trump put? Where is the Trump put? And I think we know at least somewhat where the Trump put might be. And again, as Julie pointed out, actually might have been triggered by what happened in the bond market overnight. You think about unintended consequences and things breaking when there's a lot of volatility. And I think one of the reasons the market is so strong this afternoon is that we've probably taken some of those catastrophic cascading events off the table for now. But that would be my best guess as to the why now. And by the way, this is not over by any stretch. It's a pause, and we're going to go through another 3 months of negotiations and rhetoric.
Chris, that's a great point. We got to leave it there for right now because we want to listen into some comments from President Trump live right now.
Insane, and they were dumping them into our country. And I'll tell you, Tom Homan and Kristi Noem are doing a fantastic job in removing them. And now the courts, the Supreme Court just gave us numerous good rulings where we have to be able to get them out. You had other judges trying to take over the system. And think of it, they take over. They want these people coming back, Tren de Aragua from Venezuela, the Venezuela jails that cut off the fingers of a man in Colorado. They cut off his fingers because he called the police looking for help. They said, "Did you call the police?" He said, "Yes, I did." "Put your hand down," and they cut off the fingers. This is what they want to bring these people back now. And I want to thank the president of El Salvador for the job he's done, because that's the way it has to be done. And it's too bad. Yeah, please.
Chuck Schumer and Nancy Pelosi, they've been talking about tariffs for decades. How come when these Democrat elites want tariffs, everything's hunky-dory, but when President Trump wants tariffs, all hell breaks loose? Do you see this double standard?
I love this guy, whoever the hell that is. That's really nice. I appreciate that question. No, Chuck Schumer and Nancy Pelosi, everybody knew you had to do it, but they never had the guts to do it. It does take guts. It even takes guts for our country to go through it. That's why I say be cool. They were saying about, just be cool. It's going to work out. It's going to work out, and it's working out. I can tell you, working out maybe faster than I thought. But I said it's going to take a little conditioning. It's a transition to. It's really, I think it's a transition to greatness. It's going to be greatness. Our country is going to be. There'll be nothing like it, and people investing in our country, they're going to do better than they've ever done before. We have more car manufacturers, Roger, coming into our country now. Speaking of cars. We've never seen anything like it. And they're coming in because of the election, but they're coming in because of the tariffs, because they don't want to pay 25 or 50 or whatever it may be. They don't want to pay that. They can't pay that. We had 3 cancellations in Mexico, building a plant. They're all coming into the United States. Canada, they're coming in. From China, they're coming in from everywhere. And that's just cars. We have chip makers come. We're the biggest chip maker in the world from Taiwan, coming in, spending $3 billion to build plants, and mostly a big plant. This is a hell of a plant when you spend the kind of money there. They're going to go $200 to $300 billion, not million. You know, you'd say million would be the right number. It's not. $200 to $300 billion. Think of that. $300 billion. If you look at Apple is going to spend $500 billion building a plant. They wouldn't be doing that if I didn't do this. They'd just keep building them in China. And that's unsustainable. It's not a pleasant thing to do, but I appreciate the question. And, you know, interestingly, Chuck Schumer and Nancy Pelosi, Crazy Nancy, they've wanted to do this for years, but they never had a president that had the guts to do it, because it does take guts, believe me.
Was it the bond markets that persuaded you to reverse course?
I was watching the bond market. The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. But yeah, I saw last night where people were getting a little queasy. I think everything had. Well, the big move wasn't what I did today. The big move was what I did on Liberation Day. We had Liberation Day in America. We're liberated from all of the horrible deals that were made, all of the horrible trade deals that were made. And I was helped by people just like this, senator, congressman, and friends, right? And we had great help in the Senate. Our Republican senators have been amazing. They stood tall. And likewise in the House. And John Thune has done an amazing job. Barrasso has done an amazing job. I can't think of a senator, really. We had tremendous support. We got a bill passed the other day with almost unanimous support in the Senate. And I think we're going to get that in the House, too. And I have to tell you that Mike Johnson is a great speaker. He's done a fantastic job. We had a majority of 1. Now we have a majority of 7. And you don't realize how big 7 is until you have a majority of 1. 7 sounds like so much. But we're doing well. But Mike Johnson and John Thune have done a really great job.
Mr. President, was there anyone who influenced your decision? Did you speak with anyone? Jamie Dimon? Did you speak with anyone?
Well, I watched Jamie Dimon on Maria Bartiromo's show this morning, and he was very good. He said that actually made the statement to effect that something had to be done with the tariffs and trade. He said that. He said, look, at some point, but he said something has to be done with tariffs and trade. He understood it. He's very smart and very a genius financially. He's done a fantastic job at the bank. And he knows that. Everybody knows that. Anybody that's even a little bit smart knows it. It wasn't sustainable what was happening. Somebody had to pull the trigger. I was willing to pull the trigger. This should have been done long ago. Just like Biden should have stopped the border long ago. I mean, allowed 21 million people plus into our country, many of whom should never have been allowed out of prisons and jails. They came out of prisons and jails from all over the world. And now we're getting them out, bringing them back to their countries. But it should have never been done.
Where does the takeoff decision stand?
Yeah, go ahead, please.
Sir, would you consider exempting some U.S. companies, maybe some larger companies who have been hit hard in the markets the last few days during this 90 days?
As time goes by, we're going to take a look at it. There are some that have been hard. There are some that, by the nature of the company, get hit a little bit harder, and we'll take a look at that, yeah.
How will you determine that over the next 90 days?
Just instinctively, more than anything else. I mean, you almost can't take a pencil to paper. It's really more of an instinct, I think, than anything else.
Credibility like? Because you said that these tariffs would go into effect on Monday. You said no pause. And today there is a pause. So how can people believe your words today?
It's not a question of that. You have to have flexibility. I could say, here's a wall, and I'm going to go through that wall. I'm going to go through it no matter what, and keep going, and you can't go through the wall. Sometimes you have to be able to go under the wall, around the wall, or over the wall. These guys know that better than anybody, right? You got to go around them sometimes. You're not going to go through them. So I consider, I think in financial markets, because they change. Look how much it changed today. We went from, pretty moderate today, but over the last few days it looked pretty glum, to, I guess they say it was the biggest day in financial history. That's a pretty big change. And I think the word would be flexible. You have to be flexible. Like he's asking the question about some companies. Some companies, through no fault of their own, they happen to be in an industry that is more affected by these things than others. You have to be able to show a little flexibility. And I'm able to do that. I'm going to say hello to these champions because they are great champions.
We just heard from President Donald Trump speaking about his decision to reverse and not impose the more punitive tariff rates on countries around the world, instead imposing a 10% baseline tariff and then a 125% rate on China. He talked about why he did it at the beginning of his remarks, saying that people were panicking, and he did concede he was watching the bond market. He didn't say if this was a reaction to that, but he did say he was watching it. And in answer to a question, he did say that the administration would consider exempting some individual companies. He also said this is the biggest day in market history. Maybe in dollar terms, it might be, because markets are near their highs and their lows from a historical perspective. But we are seeing big gains across the board, certainly.
Yeah, I thought the exemptions was a really interesting comment too, because obviously, especially if you're an Apple investor, your ears probably perked up a little bit there. Asked about their exemptions, going to be tariff carve-outs, and dismissed that. Says, we'll take a look at that. That's something we'll take a look at. Yeah. Wait and see, Julie.
Wait and see. Just wait. Maybe he'll say something different later today.
Could be. Could be this segment. He could say something different.
Right. Meanwhile, he did say that he was watching the bond market, and certainly that has been a very interesting story as it's been evolving, because Treasury yields have not reversed. they're still rising, not showing much reaction to the president's 90-day reciprocal tariff pause. Yet the concerns surrounding Treasury yields, they could still continue. Here with more Yahoo Finance's Alexandra Canal, who, along with many of us, has been trying to sort of get to the bottom of what has been going on with Treasuries, which we had seen yields pull back dramatically. And then over the past few sessions, they just went up.
And to your point, they're significantly up today. If you take a look at the 10-year, it's up about 14 basis points. We're trading at 4.4%. Same thing with the 30-year yield, up 8 basis points right now, trading at around levels of 4.8%. So we're still rising, building on those historic gains that we saw to kick off the week. And it's that sharp and steady jump as the catalyst for really what's been so concerning to strategists. We've had Eddie Ardeni from Ardeni Research. He came out with a note and told clients on Tuesday that something, quote, may be about to blow up in capital markets as a result of all of this back and forth trade policy. One concern is that China, Japan, and other foreign buyers will stop buying U.S. treasuries, essentially boycotting our debt. Other concerns stem from the potential unwinding of this so-called basis trade. Now, this is a highly leveraged trading strategy, most often used by hedge funds, and it occurs when traders attempt to profit from a small price gap between treasury futures and actual government bonds. So the basic idea here is to buy the bonds at a cheaper price and short the more expensive futures contract with the hope that the two prices will eventually merge. The problem, though, is that hedge funds use a lot of borrowed money to do this at scale, sometimes up to 100 times in leverage bets, which means that if the price gap worsens, those small moves can create pretty significant losses. So shocks like tariffs and economic recession, all of that could rapidly unwind these highly leveraged positions. And then you have the Fed component of it all, right? Torsten Slok from Apollo Global, he said that if the supply of treasuries expands due to the growing budget deficit or the Fed reducing its balance sheet, that could also depress treasury prices and therefore hurt the long leg of the trade. Plus, we have this fear that perhaps tariff-induced inflation, it's not going to be transitory like the Fed has suggested. So a lot of possible catalysts out there when it comes to what's driving this surge in yields, but still so many unknowns here. We have to sort of adopt this wait-and-see approach, which the Fed has already said they're going to be doing.
When you talk to these fixed income gurus, Allie, and you ask them where's the benchmark 10-year ahead from here, what do they tell you? And what degree of confidence do they have when they tell you?
The silver lining here is that a lot of the strategists that I've been speaking with say that yields will come down over the long term, particularly in the back half of the year. We just spoke with Mark Newton from Fundstrat. He has a 3.5% yield estimate for the 10-year. Coming in the fall, HSBC strategists, they had the same take, also keeping that same 3.5% prediction. And a big reason is that there's no real catalyst for why yields should surge dramatically from here. Now, Mark Newton did say that we still could see yields tick higher over the coming weeks. But again, we'll just have to wait and see.
Yeah, that Mark Newton, that's a smart technician.
Yes, we'll get him back.
Yeah, we should. Thank you, Allie. All right, as stocks rally today, one member of the Fed continues to pour cold water on the idea of any near-term rate cuts. Yahoo Finance's Jennifer Schonberger joins us now with more. Jen.
Good afternoon, Josh. Lots changing here quickly, as you guys just showed on our air, ahead of the president's 90-day pause on a swath of tariffs. Fed officials continuing to take a cautious approach, with many seemingly more worried about the prospect of higher inflation from the president's now potential tariffs, and less concerned perhaps about lower growth. Minneapolis Fed President Neil Kashkari this morning poured cold water on the notion of any near-term rate cuts. He wrote in an essay that, quote, "In my view, the hurdle to change the federal funds rate one way or the other has increased due to tariffs. Given the paramount importance of keeping long-run inflation expectations anchored and the likely boost to near-term inflation from tariffs, the bar for cutting rates, even in the face of a weakening economy and potentially increased unemployment, is higher," end quote. Elsewhere, Richmond Fed President told reporters in Washington that he sees a scenario where Fed officials could hold rates at current levels for the remainder of this year. Meanwhile, we did also get Fed minutes from the policy meeting 3 weeks ago. And even though Fed Chair Powell said in his press conference that the base case is that he sees higher inflation from tariffs proving more transitory, at that time, several thought that inflation could prove more persistent and that, quote, a majority of officials noted inflation stemming from various factors could prove more persistent than projected. And even as officials saw upside risks to inflation, they saw downside risks to growth and employment, acknowledging that could pave the path for some hard trade-offs later this year. Guys?
Yeah, Jen, obviously a lot of moving parts for the Fed and the rest of us to continue today. And Ali Canal is still here with us as well. And I know, we've all been watching the bond market. Are we hearing the Fed sort of address what we've been seeing in the bond market at all?
It's so funny because I was just with Tom Barkin this afternoon from the Richmond Fed, and he just wouldn't touch it, saying that he hasn't been following the latest movements and he didn't want to get ahead of what was happening. And, hindsight's 2020 makes sense now because the president pulling back after the bond market seemed to be ripping higher, and there were questions about whether investors were losing faith investing in U.S. Treasuries. There were questions about, is China selling U.S. Treasuries? And Ali delved into a little bit of that as well just moments ago on the show. I do think, though, that at this point, the Fed would not have stepped in with the Fed put to bail out the markets. I think that we would have needed to see even stronger reactions in the markets that would have affected the real economy for them to begin moving.
And Jen, any talk with your sources when it comes to the Fed reducing its balance sheet and the impact that could have on longer term yields?
Ali, the Fed's looking kind of smart right now, right? Because when they said they're going to slow down the balance sheet runoff at the last meeting, we all kind of scratched our heads and thought, well, why now? And, maybe that's helped cut down on some of what could have been even more potential volatility. However, in the Fed minutes, we saw that there were several Fed officials who actually disagreed with that notion. Of course, if we see any activity in money market funds, any volatility that upsets what we've been seeing even further, then I think the Fed may revisit it. But at this point, they are content to sit back and sort of observe things right now.
And it seems like they got a little more breathing room today. Jennifer, Ali, thank you so much. Markets are rocketing higher as President Trump announces a 90-day pause for some of the reciprocal tariffs ex-China. At the same time, he did raise the tariffs on China to 125% effective immediately. For more on the ripple effects of Trump's volatile trade strategy, let's get to Interactive Brokers senior economist Jose Torres. What a whipsaw, Jose. And we had economists over at Goldman Sachs who just said that we were likely to see a recession. After we got the announcement from President Trump, they said, never mind, not going to happen. Are we in the clear? It doesn't feel like we're in the clear here, Jose, I got to say.
We're not in the clear. Great to see you, Julie, Josh, Alexandra. Things are very binary these days. If you have a tariff rate in aggregate that's roughly 28%, and now you're dropping it roughly to 10% plus China, call it 13%. That's a huge shift in policy. So President Trump—
But you still have 25% on Canada and Mexico, it looks like, plus the sector tariffs. I don't know if that changes the number, but you still have some significant ones out there.
You do. Now you have some offsets. This morning you had crude oil trade at a 51-month low, and I think that's part of the administration's strategy. They understand that goods price pressures could flare up, but if they embark on the drill baby drill policy and keep pressure on China, which is the world's #1 importer, then you can subdue crude oil prices and gasoline as a result. In fact, tomorrow's consumer price index expected to be 0% month over month, driven almost entirely by a sharp decline in what I'm expecting to be a sharp decline in food and energy costs, despite services and goods picking up.
But to keep it real simple, Jose, let's just say I want to stick the basic universal 10% tariff. As an economist, I ask you, what does that actually mean for growth? What does that mean for inflation? You say what?
Well, in the short term, it weighs on growth and it pushes up inflation at the margins. But that's only on goods, and we're a much more services-oriented economy. This administration is operating with a short-term pain, long-term gain kind of framework. They want to onshore manufacturing. They want to incentivize more operations domestically. So, that's part of the way to get there. They're talking a lot about periods of transition, detoxification process, right, cleaning it out. Also, embarking on initiatives to incentivize domestic manufacturing while at the same time trying to balance the budget, at least incrementally. Those are two very, very difficult goals to achieve at the same time. And the administration just started. We're not even at the 90-day mark.
And we're already exhausted, Jose. I mean, you know, if I'm a company and I'm trying to make a plan, this doesn't necessarily help me because now I still have to wait 90 days maybe to find out what the tariffs on my manufactured goods. You know, if I'm a Nike and I've moved, or if I'm a Lululemon and I've moved a lot of my manufacturing capacity to Vietnam, okay, so this is good news, except what happens in 90 days. So I guess the chaos, I think that Treasury Secretary Bessent would have us believe that it was strategic. If you're a company who's trying to navigate it, I guess it doesn't matter if it was strategic. You're still in a very tough spot and presumably will be in terms of trying to make investment decisions.
I agree. And in the beginning of the year, especially after Election Day, we actually saw a sharp increase in business confidence and capital expenditure momentum. And that started to pare back since January. You know, yesterday we saw a glimpse of that in the NFIB survey, you know, small business optimism down for 3 months in a row. But I think that once the clouds open up and there are clearer skies ahead and we have increased clarity, I do think that we're going to have a more diversified economy. It's going to be not just services, it'll be more manufacturing, you know, and remember during COVID too, Josh and Julie, we had a lot of, we didn't have supplies of things because none of the things were manufactured here. You know, so it's also a security aspect as well. And I think that the administration's focus on China is because they've been a bad actor on trade, not just from a cost perspective and tariffs, but also when you consider barriers as well as currency manipulation. Finally, I want to talk a little bit about why the administration chose this moment right now. It was a question for the last guest, but I want to take the opportunity to shed some insight there, provide some insight. We had a really violent bear steepening on the yield curve. You know, in 3.5 business days, we saw the 10-year go from 386 to 451, a 65 basis point move.
Huge move.
Huge move, Josh. Broke the 450 resistance level, right? So now when you go past 450, what's next? 475.5. Scott Bessent, Wall Street veteran, right? He saw that. And after this announcement, we actually see, while we were all talking here, we see the long end actually coming in and the short end is jumping significantly, the 2-year yield. So you went from a bear steepening to a bear flattening, which is actually a much better environment from an economic perspective and a financial market volatility. It keeps people more calm. Bear steepeners are really violent and they're bad for the economy and for markets.
Let me get your take on this. Heading into this, a lot of your colleagues, Jose, a lot of other economists, the R word was bubbling up, recession, right? A lot of smart folks are raising their odds. You saw Jamie Dimon on Fox Business today. He's asked about that. He says, U.S. recession, he says, a likely outcome, he says, which obviously made a lot of headlines. Do you agree with Sir Jamie? Is it a likely outcome?
I think right now we're on a coin flip, 50%. Let me tell you why. January and February, the spending numbers were terrible. That's our economic engine, is consumption. In January, the PCE, real PCE expenditures went down to a 47-month low. Retail sales in February, January, also very weak. So pretty much 2 out of 3 months in the first quarter have already been terrible. You only have March. If the shoppers didn't come out heavy last month, then first quarter GDP is likely to be negative. Our prediction market Interactive Brokers also reflect that possibility. Now, is the consumer going to recover strongly in April in the second quarter and it's just going to be a one-quarter one-off, or is the consumer under some real meaningful stress? Of course, if we start to get some labor market deterioration into the middle of the year, then we will probably have a recession. I'm expecting it to be shallow. In the beginning,
you wouldn't expect it to be deep and prolonged.
No, because right now, all we're focused on in the Trump policy mix, it's all the headwinds. It's the hard things. It's trade policy. It's tariffs, it's government spending reductions, it's immigration restriction, which, by the way, hasn't been as bad as feared. But once we turn around, folks, and we start focusing on the more positive aspects of the Trump policy mix, namely lighter taxation, milder regulations, and lower oil prices, and ideally a huge surge in capital expenditures, then we could recover from that recession and be better off. 20, 30, 40 years ago, recessions weren't a terrible thing. They were kind of like a reset, a little bit of a breather to have a more sustainable expansion later.
All right, on that positive note, Jose, always great to see you, my friend.
Terrific. Thanks you so much. Thanks.
The Trump administration backing off of a chip crackdown on NVIDIA. This is coming after CEO Jensen Huang attended a $1 million per person dinner at Mar-a-Lago last week. For more, we're bringing in Yahoo Finance tech editor Dan Halley. That's a big dinner, Dan.
Yeah, I don't think they're serving Kraft macaroni and cheese there, although I pay $1 million for that. Yeah, this is a big deal. The H20 is a chip that NVIDIA is able to export to China right now. It's what DeepSeek trained their models on when it came to their R1 and their V3 AI, generative AI models. And so the idea that this would have been kept away from China was a big deal and up for discussion. There were both Republicans and Democrats saying that they wanted it to be controlled under the export controls. And so that would have hurt NVIDIA's overall revenue in China. Now, while they've said that they're not expecting any expansion, significant expansion, and that they will miss out over the long term because they won't be able to ship things like their Blackwell chips or their upcoming Vera Rubin chips, they do still have this in their back pocket that they're able to generate revenue from when it comes to China. So it's a big deal that now they're saying that they're still going to be able to, or at least the reports are, that now they'll be able to continue to hold on to that and continue to sell it for some time going forward. We don't know how long that's going to be or what exactly that means for NVIDIA's future chips. Don't expect Vera Rubin to go there. Don't expect Blackwell Ultra to go there. But the fact that they're able to have the H20 and perhaps future kind of, we'll call it nerfed high-end chips going out there, still good news for NVIDIA.
And more broadly, you've been following big tech's relationship with the president. And, this dinner, just one example of basically big tech CEOs paying a lot of money to get close to the president and trying to convince him of their agenda.
Yeah, I mean, look, this started prior to the inauguration. We had companies ranging from Google and Microsoft to Meta and Apple, either their CEOs or the companies themselves donating $1 million to the inauguration fund. We had them meeting up with him at Mar-a-Lago regularly. Mark Zuckerberg famously appointed Dana White, one of Trump's friends, and now reportedly purchased a mansion in D.C. close enough to talk, walking distance to J.D. Vance or the White House. But it didn't save them from the tariffs until about an hour ago, maybe, right? I think the big thing to keep in mind here is, we had Apple talk about $500 billion of investments over the next 4 years. Microsoft, $80 billion over the next 4 years. It's funny that it's always over the next 4 years. Well, I wonder why. But the thing about Apple is the majority of their iPhone manufacturing is still in China.
And now, so still subject to tariffs.
So that's the thing, right? We talk about how Vietnam has a lot of manufacturing capabilities. There are other Southeast Asian countries that have manufacturing. Mexico manufactures NVIDIA servers, so the ones coming through there aren't subject to the new tariffs. But the clarity isn't there yet on which companies might get some exceptions. Trump obviously just talking about that during the press conference. And then what that means going forward and for how long, this 90-day extension. Does that mean that, okay, well, the companies are exempt, they'll be exempt past that 90 days? I do think that, when it comes to Apple, it's still kind of, everybody is tense. One of the analysts I was just speaking to was saying that, look, no company knows what to do at this point whatsoever, either through the supply chain on up, because there's just no real rhyme or reason to what's going on at this point.
Yeah, Jose Torres of Interactive Brokers is still on set with us, economist. And Jose, you were just talking about the sort of silver lining potential here. Well, I want to ask, from an economic perspective, some of what Dan is talking about. In other words, this sort of seeming pay-to-play environment that this White House has welcomed, accepting lots of money and business relationships from the crypto industry, and then going easy on the crypto industry, accepting lots of money and having these big high-ticket dinners with executives, and then potentially working out deals. From an economic perspective, is that a positive, negative? What is that? How should we read that?
I think it's a style kind of framework. The president, the White House, they want you to come in. They want to talk with you. It's similar to the nations, the 70 nations, 75 nations that Scott Bessent, Treasury Secretary Bessent, was talking about. They want folks from business, political leaders to come to the White House and have one-on-one conversations. It's not a kind of status quo kind of administration. It's part of why the voter base decided to elect the Trump administration. You know, it's a different kind of style. Let's talk face to face, eye to eye. Maybe that style, you know, you ask me if it's positive, negative, maybe it is positive. If you see someone face to face, shake their hand, maybe there's more accountability that way.
You also know, Jose, though, what this administration wants. What does Trump value? He values when you come out and you say investments. We were just talking about NVIDIA. What NPR reports is that NVIDIA promised Trump, listen, we're going to make new investments in AI data centers. That is part of the conversation. I mean, often you make that, if you can promise Trump there's going to be more direct investment, you get headlines.
Absolutely. And, you know, he loves to be around the CEOs. He loves to, you know, he loves screen time, you know, and it's part of his flavor. It's part of his deal.
Yeah, it's just interesting that it's $1 million dinner in order to get there. All right. Thank you for hanging around, Jose. Thank you so much, Dan Howley. And let's do a check of the markets here as we're counting down to the closing bell. We are seeing stocks continue to see a big rally here. The Dow right now up 2780. That's a gain of more than 7%. Stick around. More market domination still to come. Delta reporting first quarter earnings earlier today, but the headline is that the airline is withdrawing its full year financial guidance. Delta citing uncertainty around President Trump's tariffs. And today certainly isn't providing any stability. For more, we'll bring in Savi Saith, managing director at Raymond James. Obviously, Savi, our conversation's a little bit different now than it was earlier in the day. You know, all of this said, the U.S. relationship with other countries like Canada, for example, is still not repaired. And so I'm wondering, before we zoom in on Delta, just sort of high level, how you're thinking about what travel is going to look like this year, given everything that's going on.
Yeah, I mean, and it might be a case of two halves, right? Because a lot of, if you think about international, especially leisure travel, you tend to book those in advance. And so a lot of that travel has been booked. For U.S. airlines, you know, point of sale U.S. has been really important. And even if you look at versus kind of pre-COVID, U.S. kind of outbound travel has recovered much stronger than inbound travel. So while inbound travel is looking a little shaky in certain regions, and I think, you know, Canada is a great example. I think there's some softness on kind of the Mexico transborder as well. Generally, you know, what you are hearing is it's still very strong into the summer, but I think it's because a lot of those bookings happened in advance of, you know, last week's developments.
Savi, I've got to ask you about some of the moves I'm looking at right now with these airlines following this Trump tariff pause. Savi, United Airlines is up 27%. Delta is up 24%, Savi. What do you make of these moves, Savi? Are they in any way justified, in your opinion, off those Trump headlines?
Look, if we're not going into a recession, it's definitely deserved. I suspect there's short squeeze involved here. It's really hard to tell, you know, but it really looked bleak when those tariffs were going to go into effect. And I think the fact that the administration's signaling that they're willing to, you know, take things in stride and make sure that they don't kind of move too fast and break too many things is probably being viewed as some relief here. Because at the end of the day, really for the airlines, what matters is what happens to the economy, because that's what drives demand. And so, you know, there's a bit of a relief here that maybe we're not, you know, heading into something really bad necessarily.
So, Savi, let's get back then to Delta and sort of to the specific airlines here. It feels like consensus is sort of that Delta is best positioned. I know you have a strong buy on the stock. Is that sort of the case whether or not things are okay now or not? In other words, is Delta well positioned regardless?
Yeah, I mean, I think there's near-term risk, right? If we do head into a recession where earnings are going to be down, you saw Delta pull their earnings forecast. I think the key here is just the earnings volatility at Delta should be a lot more manageable. I think they're doing the right thing. You saw Delta talk about second half growth, that they're going to take it down a flat year over year. They were planning to grow 3 to 4%. So they're doing all the right things, what they can control. What was really interesting is that they're taking that growth down and still managing to keep cost, up low single digits, unit costs. And so that is not an easy feat, but I think they're targeting the right things. And between that, they have really high profit sharing that gives you a bit of a relief valve. They're coming into this from a strong position in terms of margin, and they should drive free cash flow this year. So all of these things come together that I think you can look past kind of a short-term hit to kind of earnings levels because you know that they'll be there and they'll be strong on the other side of this.
Savi, always great to see you. Appreciate it. Thank you.
My pleasure.
Retailers are navigating through uncertain times as the tariff headline is constantly changing, and even juggernauts like Walmart trying to sort through it all. For more, we're bringing in Yahoo Finance senior reporter Brooke DePalma. Brooke.
Good afternoon to you both. I mean, if we've learned anything, this environment is not for the weak, and that certainly stands true when you think about Walmart. They started out this morning saying that tariffs would be taking a toll on their profits. Of course, they said that prior to this 90-day pause, that 10% still in effect and 125% on China. Keep in mind, Walmart did share that one-third of goods that it imports, China is one of Walmart's quote-unquote most significant countries that it does import from. And now China has that 125% tariff on imports there. But many analysts that I've been speaking to all day has said that Walmart is entering this environment with a position of strength here, which you can't say for many retailers. That's largely because of the sheer scale that Walmart has. It's far larger than others. And it also has these high margin revenue streams that we were hearing a lot about today, including their e-commerce and advertising business, Walmart Connect. We did now learn that their e-commerce business is expected to be profitable in Q1, their U.S. e-commerce business, and the entire business is expected to be profitable by the year end on an annual basis. And when you think about just how much of an e-commerce jump we saw last quarter from Target compared to Walmart nearly doubled their e-commerce growth year over year. Also, the advertising business is huge for Walmart. Walmart Connect grew by 24% in the U.S. last quarter. That's compared to Target's Roundel business up just 13%. And Walmart CFO actually said this morning to investors that in this sort of environment, they know they see an increase in foot traffic. Where do advertisers want to be? Where the eyeballs go. Mm-hmm. And so Walmart's certainly positioning themselves in this environment, saying that they have a position of strength. And no matter what happens here, more people will come in uncertainty. Lots to unpack there.
Yeah, Brooke, thank you for helping us do that. Appreciate it. Let's do a quick check of the markets here as we count down to the closing bell. We continue to see stocks build on their gains. Incredible magnitude here, particularly for the NASDAQ, which just keeps climbing. It's up 12% right now. The S&P 500 up nearly 10% in a single session, and the Dow climbing by 3,000 points, up by 8%. Much more market domination still to come.
While stocks are higher today, tariff volatility has many investors wondering where to turn for their portfolios. According to our next guest, one area that has shown some signs of stability is the real estate sector. And joining us now to discuss investing opportunities within real estate, we got David Steinbach, Hines Global CIO. Hines, one of the largest privately held real estate investors with over $90 billion worth of assets under management. David, always great to see you, especially on set.
Great to see you.
So let's start off with the Trump tariff pause. Obviously, listen, the markets are ripping higher on this. I'm curious, you're a real estate investor, so you saw that headlines. How are you now trying to think through what that means for your sector, David?
I think it's really important to remember that private markets and public markets are very different places in terms of the cycle. And obviously, private markets, are frankly slower in many ways to react to headlines. They're immune to some of the ups and downs, the volatility that we're seeing right now in the public markets. They're thinking about things on a different time horizon, which is a much longer time horizon. And frankly, the private markets are still coming back from a reset that happened in March of 2022 when interest rates started to go up. And that was a 500 basis point journey that really brought the real estate markets down cycle. And the lack of new supply that's really affecting the markets today, really that journey began March of 2022.
So then I'm really curious what you've been hearing from these private market investors. In other words, we talk to public market investors all day long. And they've been freaked out, right? They've been worried. Of course, the people who are in the private markets also are in the public markets, and so they're seeing their stock holdings and have been seeing their stock holdings at least go down. But have you been seeing less willingness to invest in real estate, or has it been unaffected by what's going on?
We're seeing a real shift actually towards real assets the last few years. I think what investors are starting to they're looking for a balanced portfolio. They're looking for great risk-adjusted returns. And when you look at what's going to be happening likely the next decade in terms of monetary policy, geopolitics, a lot of things are pointing to signs that we are going to have more friction cost in the global economy. I think even seeing what happened today with tariffs, once you squeeze all the toothpaste out, it's really hard to put it all back. And I think that we will have more friction cost in terms of some form of tariffs that will be higher now than they were the last 50 years. And so those things, combined with several other factors, are driving a view that there will be a bit more inflation coming through the system the next decade. In light of that, a lot of investors are looking at owning real things, hard real estate being one of those, as being a great investment category. It's cash flow. As the cost to replace it goes up, you will have locked in what you own. All those things make it a great inflation hedge for investors, and they take that longer term lens in terms of what's happening with the global economy. The second thing that I think investors are looking globally at is the deglobalization that is occurring, and we're seeing it right now in front of us in terms of what's happening just on the global stage today in the White House. And what I think investors are looking at is that they have to have more resiliency in their supply chains right now. And that will end up spurring more development as we go. And similar after COVID, a lot of market participants were saying, look, we need China plus one in terms of our supply chain. Now a lot of global supply chain players are saying we need US plus one. And so putting more resiliency into their supply chains is becoming an important theme that we're hearing.
David, if rates were to stay here, or even maybe move a bit higher, that would mean what for the real estate sector?
So the market, within the private markets, real estate is looking at rates as higher for longer, is the mantra that most participants are talking about. So what that means is when you underwrite deals, investors are really looking at rent growth and cash flow, getting returns more from cash flow than from financial engineering, which is what happened after 2008. And that is going to be a much more sustainable way for the asset class to be performing, and we're excited to see that. And we see that while rent growth might not be today, because the market, there are real risk of recession coming, the lack of new supply coming in is getting to historic levels in some of the asset classes. And so that will catch up with the system. And for those that own the right real estate, they'll be able to take advantage of that.
David, really quickly, most of our viewers are retail investors. Real estate has traditionally been an asset class for the wealthy, right? There are minimums, et cetera. Is it opening up? Is it becoming more accessible? And how is that happening?
I think the market is moving very quickly to, as they say, democratize the asset class. And it has been really only for those that can really write really large checks. Yeah. And the market has been doing a great job in breaking the ability, opening up the aperture of allowing individual investors to come in. So there's a lot of great products out there. We have one as well, and it has performed well in this last few years, despite the headwinds we faced on interest rates. These products will continue to invest, and right now is a great time to be investing, and they'll be making selective investments as we speak.
David, great to see you. Appreciate your time.
Thank you.
Thanks.
Let's check in on the markets as we are just a few moments away now from the closing bell after this Trump tariff pause, which was a surprise, obviously, a reversal. You can see the popular averages are surging here. Got the Dow up nearly 3,000 points. The S&P 500 is up more than 9%. The tech-heavy NASDAQ is up about 12%. I'm just looking at some of the sectors here. Look at the MAGs, the ETF that tracks the Magnificent Seven, of course. That is up in today's trade, up more than 14%. The SMH, that's the ETF that, of course, tracks the semis, that is up more than 17% right now, Julie.
Yeah, I think something that Savvy Saith, who covers Airline, said earlier really bears repeating, which is undoubtedly there is something of a short squeeze. That is a factor. It's not the only factor. Obviously today, the news is the big factor. But undoubtedly there's something of a short squeeze going on in markets here that exacerbates and exaggerates some of these moves to the upside. Also considering all the options activity that goes on in markets, that's something that one has to consider as well. But obviously large cap tech is helping lead the rally here. You see that from the outperformance of the NASDAQ.